Welcome to this explainer. Let's just address the multi-trillion-dollar elephant in the room right away. As an investment committee, you're managing massive capital allocations in an equity market heavily dominated by artificial intelligence. But with valuations soaring and headlines constantly screaming about speculative mania, we really have to ask the critical question, are we facing a repeat of the late 90s dot-com crash? Have we officially entered an AI bubble? Well, to answer that, we're going to rely on hard data. We'll be looking at recent structural analyses from the Amundi Investment Institute, along with comprehensive market research to cut right through the noise. Here's our agenda for today's briefing. We're going to cover the anatomy of a bubble, the displacement phase, the reality behind valuations and earnings, concentration and capex risks, and finally, institutional risk management. All right, Section 1, Anatomy of a Bubble, a historical framework. So when we talk about asset bubbles, historical examples like the 17th century Dutch tulip mania often jump to mind, right? But the internet boom of the late 90s is definitely our most relevant modern benchmark. Charles Kindleberger, a renowned economic historian, outlined 5 specific stages of speculative bubbles, and we can map them out perfectly using the dot-com era as our baseline. It starts with the substitution or displacement stage around 1995, where a new technology really captures investor attention. That's followed by the takeoff or boom stage in 97, leading to full-blown exuberance or euphoria by 99, which is totally characterized by stretched valuations and massive retail inflows. Finally, we hit the critical profit-taking stage in 2000, inevitably followed by the crash and panic. To accurately diagnose our current AI market, we've got to pinpoint exactly where we are on this historical map. Section 2, the displacement phase, mapping the AI cycle. Okay, let's dive into this. Notice how closely the current trajectory mirrors the past. We're tracking the cumulative returns of the late 90s tech, media, and telecom, or TMT portfolio, against our current S&P 500 AI portfolio. And the AI trajectory from 2023 to 2025 practically traces the exact takeoff and exuberance phases of the TMT sector from 1997 to 1999. In fact, over the last 3 years, AI stocks have outperformed non-AI stocks by a massive 212 percentage points. At first glance, this explosive price action looks literally exactly like a late-stage bubble. But as you'll see when we dig deeper into the fundamentals, a very different picture emerges. Section 3, Valuation and Earnings Reality, the Fundamental Divergence. Let's look at the price-to-earnings, or PE ratios, specifically comparing the last 12 months and next 12 months multiples. During the dot-com boom, TMT multiples continuously expanded to extreme levels, peaking at an astronomical 54.3 times realized earnings. In contrast, look at the AI portfolio today. While AI stocks have clearly experienced massive price appreciation, their valuation multiples have actually compressed. From 2023 to 2025, the trailing PE for AI dropped from over 40 down to 34.2. Even more revealing, when quantitative analysts apply an autoregressive statistical test to these periods, the dot-com era showed coefficient values greater than 1, proving it was an explosive, non-stationary bubble process. The current AI market, the coefficient falls below 1. Statistically speaking, that outright rejects the presence of a speculative bubble. The fundamental contrast here is honestly striking. The TMT era was totally characterized by hype-driven valuation expansion. Prices soared completely detached from underlying cash flows. The AI era, on the other hand, is defined by earnings-driven valuation compression. Forecast earnings for AI firms, which are driven by tangible hyperscalers' demand, advanced networking equipment, and high-margin semiconductor sales, are actually outpacing their phenomenal stock price gains. NVIDIA, for example, generated over $81 billion in a single quarter. This proves we're witnessing a fundamental re-rating of a general-purpose technology rather than an explosive, irrational bubble dynamic. Section 4. Concentration and capex risks. The real threats. Let's anchor our narrative in reality with this number, 50%. Roughly half of all S&P 500 total returns since 2023 have been driven by a highly concentrated AI portfolio. What's truly concerning is the structure of this concentration. During the peak of the dot-com boom, the TMT portfolio comprised about 100 stocks, with an average weight of 47 basis points. Today's AI portfolio is generating that same 50% market contribution with just 45 stocks, carrying an average weight of 87 basis points. This means standard equity allocations embed massive implicit exposure to a very narrow group of companies. If those specific firms stumble, the entire index feels the shockwave. And what might actually cause him to stumble? Capital expenditure execution risk. Think about this staggering figure, $35 billion. That is Microsoft's AI infrastructure spend in a single quarter. Across the board, the AI sector's CapEx intensity ratio is surging, currently sitting at roughly double that of non-AI stocks. While the semiconductor layer is enjoying high gross margins and bottleneck rents right now, the cloud platforms and hyperscalers are engaging in massive defensive overinvestment. The risk isn't that the technology is fake. The risk is that this massive infrastructure build-out earns a low return on invested capital, or that power constraints and grid bottlenecks cap their useful deployment. Section 5. Institutional Risk Management. Actionable Strategies. So the mandate for portfolio managers right now is crystal clear. Stop trying to time a market crash based on a flawed .com analogy. Instead, focus on mitigating drawdown amplification. You need to manage strict concentration limits and maintain very disciplined rebalancing protocols. Crucially, keep a close eye on market breadth. If we see capital rotating out of overvalued mega-cap tech into mid- and small-cap names, that's a sign of healthy market repricing, not a narrative collapse. And we absolutely must continuously assess the sustainability of this CapEx cycle. Ensure your models account for potential interest rate-driven multiple compression, because risk-free treasury yields can heavily impact the valuation logic of these long-duration growth assets. And this brilliantly illustrates the core challenge we face today. I want to leave you with this provocative question to really ponder. Are we actively managing the real execution risks of the AI CapEx cycle, or are we dangerously distracted by the bubble debate? The data shows the earnings are very real, but the concentration is totally unprecedented. As professional investors, our job is not to fear the revolution, but to rigorously price it. Thank you for joining me for this explainer. Keep evaluating those fundamentals and stay focused out there.